hope for the best and prepare for the worst. So every week or two, I go over current state of the economy and then into interest rates, because it'll help you hopefully get a plan together to get out of debt as soon as possible. So in this first article, it's the Citibank's chief economist, and they're talking about 2024 potentially going into a recession, what it means and how it may impact you. The biggest one is job losses. In a recession, typically unemployment seems to skyrocket. And if that happens, you or a loved one or a partner may end up losing their job for a period of time. Sometimes the best you can do is just prepare. So decrease the amount of money that goes out the door every month. In other words, lower your expenses as much as possible. That's why I go through many videos on getting out of debt. A lot of debt payments, it's just interest going somewhere. You don't want that. And if you've got multiple debt payments, of course, that increases the amount of money you need every month to survive. For example, if you typically spend around $5,000 a month, you want to be able to survive for 6 months. If you were to lose your job, that's $30,000. Well, if somehow you were able to get that $5,000 down to $4,000, then you only need $24,000. As you can see where this is going, if you need $3,000 a month, and then for 6 months, you only need $18,000 saved. So you'll be able to last longer on your emergency fund if you can decrease your expenses. One way is to get rid of as much debt as you can. The other thing I wanted to point out, and this is more of a long-term thing, that this is a very interesting article about Gen Xers. I believe it's 44 to 50 something. And essentially they're talking about retirement savings. They say the widespread move from DB plans to defined contribution or 401k plans. What does that really mean? Well, in the past, let's just say that there was a high percentage of industries that would provide retirement benefits through a pension. They call it a DB plan. That's a defined benefit plan. Think of it as a pension, meaning you work a certain number of years in a particular industry for a particular company, and when you retire, they provide you with an amount of money every month until the day you die. That seemed to be, or was, much more prevalent in the past. It still exists in some industries and businesses, but not many. Things have shifted to a 401k plan, which means what they call a DC, defined contribution. That means that you are responsible to save the money. With a defined benefit plan, the business is saving money on your behalf and then providing you with benefits. So whatever money you took home every month, you didn't have to worry about it. You were still getting that pension or defined benefit plan. Now you're responsible to make those contributions. You can do that through your 401k with your company in different ways. But the point here is you need to plan more for something like retirement, because it's on you to make sure that the money you're making every month, you're putting it into an IRA or through a 401k with the company you work for, etc. So just another reason that it would be great to get out of debt. 3 places I look and compare every couple of weeks. On the credit card rates first, you can see here they have average APR for all new credit cards. So it looks like the percentage rate has gone up a little bit. It seems to go up every single month or every single week because interest rates in general have gone up. So credit cards are around 24%. We know that, right? 20 to 30% for a credit card. You want to get out of credit card debt. I've got videos on different ways in which you can do that. Here's one. It's personal loans. They say, and they've got it here, the average has gone down slightly, but it's a little over 20%. So a personal loan, and the lowest is around 10% and the highest around 30%. It's going to depend on your credit score and other things. But it's worth taking a look, because if you can get a 10, 11, 12, 13% personal loan, spread your payments out over a longer period of time with a lower interest rate, then take it off the high interest rate, put it on the lower one, and now, for example, if you were paying $800 a month on the high interest rate credit card, and now you're paying $400 a month on the personal loan. Well, it's great if you can still make the $800 payments, but at least if something goes bad, you can fall back to that $400 if you were to lose your job or something. All right, so here are car loans, and this has it broken down. I like this by your credit scores. So you can see about what rate you should be getting depending upon what credit score you're at for a new car or a used car. I like to show this for 2 reasons. One, because if you're going out, let's say, for example, you decide, hey, I'm going to sell my more expensive car and I can buy a least expensive car. What kind of rates are you looking at, whether it be a new car or a used car? The second reason is when you're trying to get rid of debt, if you can move debt onto lower percentage rates. So obviously a balance transfer of credit onto a 0% card or a personal loan at 12% instead of a credit card at 30%, at least you're making progress, right? Another thing, and I've got many videos on creative ways of transferring debt to different types of instruments, if you will. So think about this example. If you have a credit card and you owe $4,000 and it's at 30%, you have your car, you call them up and you say, hey, can I refinance this vehicle? And they say, sure, we'll give you $14,000. Okay, you owe 10. So they take of the 14, 10,000, they pay off the note that you owe, and then they give you 4,000 cash in your bank account. So now you have a new car loan at 14,000, not 10. So your car loan's gone up. But if you look here, if you're, let's say 660 credit, you might get a 10% loan. Well, is 10% for $4,000 better than 30% on that 4,000? Sure. So you take the 4,000 out of the bank account, you pay off the credit card. Yes, your car loan has gone back up, but you've gotten rid of the credit card at 30% and you moved it onto an instrument at 9%. That's just one of many creative ways that you can use to help get you out of debt. Take a look at some of the other videos I've got. So that's it for this week. Thanks for watching. I hope this is helpful.